All right, let's get right into it. Today, we're tearing down the latest earnings report from the banking behemoth UBS. But look, this isn't your average run-of-the-mill numbers release, not by a long shot. This is really a progress report on one of the biggest, most complicated bank mergers we've ever seen, the massive integration of their old rival, Credit Suisse.
So the question on just about everyone's mind in the financial world has been this. After that huge government-brokered takeover, how is this thing actually going? I mean, this is a colossal task. So how's UBS handling it? Well, that's exactly what we're going to dig into.
So here's how we're going to break it all down. First, we'll hit the big headline numbers. Then we'll go inside the mega merger itself. After that, we'll look at the business engines, what this all means for investors, and finally, we'll take a peek at the road ahead. Let's jump right in.
Okay, first up, the headline numbers. And yeah, for the fourth quarter of 2025, they definitely delivered a decisive beat. These numbers really got the market buzzing, and for very good reason.
So, the one number that everyone always zooms in on, earnings per share, or EPS. And UBS came in hot at 37 cents. Right out of the gate, that set an incredibly positive tone for everything else they had to say.
But you know, that 37 cents number doesn't even tell the whole story. You have to see it in context. The analysts, the experts, they were forecasting maybe 25 cents a share. UBS blew past that. For revenue, Wall Street was looking for just under $10 billion. UBS delivered over $12 billion. So this wasn't just a small win. No. This was a massive beat across the board, signaling some serious underlying strength.
Okay, so the numbers are great, right? But what's really amazing is that all of this is happening while they're in the middle of this massive, once-in-a-generation integration. So let's get into that. How's the mega merger itself actually progressing? Well, even the CEO, Sergio Ermotti, isn't mincing words here. He's straight up called it one of the most complex integrations in banking history. I mean, that really puts into perspective the sheer scale of what they're trying to pull off.
And what's clear is they have a very methodical plan. They're not rushing this, they're hitting these huge milestones one by one. They already finished moving all the Credit Suisse clients over in Asia Pacific. That's a check. Next up, they're on track to wrap up the very complex Suisse client migrations. And the big one? The goal is to have the entire thing pretty much done and dusted by the end of this year, 2026.
And get this, the deeper they dig into this merger, the more value they seem to be finding. They're uncovering so many new efficiencies that they've actually upped their cost savings target to a massive 13.5 billion Swiss francs. That's incredible.
Okay, so let's pop the hood for a second. How are the bank's core divisions, its actual business engines, holding up while all this construction is happening around them?
And really, it's a tale of two halves. On one side, you've got the absolute powerhouses, Global Wealth Management and the Investment Bank. I mean, they are just firing on all cylinders. But then on the other side, the more traditional personal and corporate banking arm is feeling some serious pressure, mostly from that low interest rate environment.
And when I say firing on all cylinders, the scale is just mind-boggling. The Wealth Management division is now sitting on almost 4.8 trillion in invested assets. They pulled in over 100 billion in net new assets just last year. Meanwhile, the Investment Bank, it just had its best revenue year ever. We're talking 11.8 billion. That kind of momentum is absolutely crucial for funding this entire integration.
So, the big question is, what does all this strong performance and disciplined work mean for investors, for the people who actually own a piece of the company? Because at the end of the day, this is why it all matters, right? Let's talk about the payoff.
First thing, a very direct reward for shareholders. The bank is proposing a dividend hike of 22%, jumping from 90 cents a share to $1.10. That is a powerful signal of confidence in their financial health.
But it doesn't stop there. On top of that dividend, UBS is planning to buy back a whopping 3 billion Swiss francs worth of its own stock from the market in 2026.
And you know, for anyone who needs a quick refresher, a share buyback is another way to return cash to shareholders. The company uses its own money to buy its stock, which reduces the number of shares out there and, in theory, makes each remaining share more valuable. It's basically management saying, hey, we think our own stock is a great investment right now. Okay, so with the heavy lifting of the merger progressing so well, management is now looking to the future. And let me tell you, they are setting some seriously ambitious goals.
So here's a look at their roadmap. By the end of this year, they want that all-important cost-to-income ratio below 70%. That's a key measure of efficiency. And they're targeting a return on capital of around 15%.
But look further out to 2028. Their ambition is to attract a staggering $200 billion in new client money every single year.
And here's the kicker. The goal by 2028 isn't just to get back to where they were before the merger. No way. They're aiming to be more profitable, targeting a very strong 18% return on capital. They're planning to emerge from this whole historic saga stronger and more efficient than ever before.
So, that leaves us with the big, forward-looking question, doesn't it? The progress so far has been impressive. They've clearly beaten expectations. But as they enter the final stages of this mega merger, can they truly harness their new massive scale to not only hit these ambitious goals, but to maybe set a whole new standard for what a global bank can be? You can bet the entire world will be watching.